On this morning's Ag Issues program, as always, a pleasure to bring on to the program Roger McEowen, Professor of Agricultural Law and Taxation at the Washburn University School of Law, as he joins us on the program this morning. Roger, good morning. How are you?
Good morning, Greg. Happy Memorial Day to you.
The same to you as well. And let's get right to it. Of course, we turn the calendar tomorrow, and it will be the month of June. And even though you're out of school at at Washburn, you're very busy. As a matter of fact, you've got your first of your two summer conferences focusing in on several topics that's going to take place June 7th and 8th. And the focus on this conference is going to be the ag economy.
Well, that's a part of it, and you're right. I am out of the academic classroom in terms of being on campus for a while. In fact, for the rest of the year for me. But my season never really ends. I just continue to travel coast to coast. And you're right. I'll be in West Portsmouth, Ohio, for a 2-day conference next week. The second of my major ones this summer will be in Montana, Missoula, Montana, in early August. And a component of what we're going to be talking about, because it's so important this year with all of the changes coming potentially with respect to tax that could affect estate planning, we get into basis issues, is the economic focus. What's going on in the farm economy? What can we expect to happen in the farm economy? So that's an important segment of these two major conferences I'm doing this summer.
Well, in the ag economy, it's no big secret. We have seen the struggles throughout here, well, in association with the pandemic, but, we started to see before that too, but really when we started to see the shutdowns across many states, that struggle, that started the struggle of the general economy itself. But how do we look at it from the ag economy's perspective?
Well, actually, a little bit different from the ag standpoint of things. For starters, net farm income was higher in 2020 than it was in 2019. And when government payments are included, net farm income was 46% higher than in 2019 nationwide. And that represents the fourth highest amount for any year since 1970. So that's the good news for ag producers and rural communities, and of course the world I'm in, the practitioners that represent them. That's a vibrancy that's out there. But I think it's important to understand that 38% of the total amount was from government payments and not from the private marketplace, and that's also a record. And that's not a good record to have, because what government gives us, government can take us away. And so we have to keep those two things in mind as they are counterposed against each other. Earlier this year, USDA projected that net farm income would drop 8% compared to 2020. But even with that drop, net farm income would still be 21% higher than the 2000 to 2019 average. So it would still be 21% higher, even with an 8% drop, than the average over the prior 20 years. And we've seen so far this year that grain prices for the major row crop commodities, corn, soybeans, and wheat, have been soaring. And those prices have been driven by strong export demand and tight stocks and weather concerns in South America, the U.S. economy coming out of the various state-level shutdowns. So we've got a lot of moving parts in the ag economy right now. And the K-State Farm Management Association numbers with respect to farm income reflect the national averages, a significant increase in 2020. Ag is an essential industry. People still like to eat, even if they are staying at home. And the level of government payments have really fattened the bottom line, so to speak.
Let's move over, look at the ag economy from perspective on the cattle market side. And you talk about people want to eat, people going out. So that means we're starting to see demand improve. We saw that as far as exports, but you add in the restaurant reopening as well. But many challenges within there too.
Yeah, what you said is true. The challenges, I think, are on the processing side of the equation, with capacity issues and higher feed prices presenting difficulties. And you've got drought in some parts of cattle country that will always be a concern. So we've got those issues. We've got some issues with respect to price spread between what packers are receiving, what producers are receiving in the retail price. And of course, we've got Congress starting to look at those things too. So there's a lot of moving parts on the cattle side of things right now.
And if you're within the dairy industry, boy, oh boy, you've seen dairy prices increasing, demand showing greater strength, but challenges also within the dairy industry too.
Yeah, the demand is showing greater strength and dairy prices are going up, but that can also be a resulting impact on the loss of numerous dairy farms, or as a result, I would say, as a loss of the numerous dairy farms in recent years that lowers production. So your prices are up maybe because production is lower because the industry has thinned itself out. We have fewer dairy farms that are out there. But feed cost is right now. Feed costs for dairies is wiping out all of the impact of the higher dairy prices. So they're just kind of treading water.
You know, you mentioned exports, and we all have seen what we have seen with exports as well. But now we're into 2021 overall, and of course, China. Everyone's still keeping a close eye on what they're doing.
Yeah, the Trump administration really cracked down on China, and it worked. And thankfully, you had the MFP payments came in initially to deal with China's initial reaction to what the Trump administration was doing, and that really sustained agriculture. But it really got us around the curve on trade with China. In 2020, total ag exports were 7% higher than they were in 2019. U.S. exports to China alone were 91% higher in 2020 than they were in 2019. So you saw that complete turnaround in breaking the back, so to speak, of the Chinese and their trade policy, with total ag exports to China being higher in 2020 than at any point during the Obama administration or any prior administration. Of course, China is critically important to U.S. ag producers in our markets. China has about 20% of global population, but only 7% of the world's arable land, and they have to import food from somewhere else. And so when you get serious, like the Trump administration did with China, global trade conduct and imposed tariffs and other sanctions against it to benefit U.S. ag producers in the long run, we can see that started to happen. So we don't like to mess with trade. You had a lot of people talking about, well, this is protectionist. Well, it was done with a purpose. You had to straighten the Chinese out. And we finally had an administration that did that. Now, the concern is, will that pattern continue? That's an open question. But so far in 2021, total U.S. ag exports are up 24% compared to last year. And a large part of that is due to the increased level of exports to China. But there are numerous other ag export markets around the world that we have to keep an eye on.
So how do we look right now? Because everyone says, all right, so what does our balance sheet look like? From your perspective, how do things look?
Well, and that's really a lot of what I focus on in doing tax planning and estate planning and business succession planning for farmers and ranchers. You want to look at that balance sheet, and farmland values continue to hold steady, if not slightly higher. I'm talking national averages. Kansas kind of follows this trend too, and the primary influence of land values are commodity prices, of course, and government support programs that get capitalized into land values. We've had a lot of those, as we've mentioned. The supply of land, and interest rates, and inflation in the general economy. Now, that last point is key there, interest rates and inflation in the general economy, because if you have shocks to one or more of those factors, that could impact land values significantly. And I think we really have to keep our eye on those last two factors there, interest rates and inflation. I see some troubling things coming out of the Fed. I think they can probably keep their foot on the brake of interest rates for probably through the rest of 2021. We get into 2022, especially if there's another $6 trillion spending bill. You got a lot of money that's being printed, and that devalues the money that's already in people's pockets, and there's your hidden tax increase right there. They may not have increased your tax rates if you're less than $400,000, but they just made the money that you're carrying around worth a lot less. It won't buy as much. Well, at some point in time, interest rates are going to have to go up to squelch off some of this inflation because of the excess money that's out there. And we've got to pay attention to that in ag. And so this is not the time to be borrowing a lot of money. This is the time to kind of get things paid off and not get into debt, because we may have some rough water ahead of time. But farm working capital has seen 4 straight years of increases after the low point in 2016. But total farm debt continues to inch upward, and the U.S. farm debt to asset ratio is right now at its highest point over the last 12 years. And but again, it's still, in relative terms, it's still far below where it was during the height of the farm debt crisis of the 1980s. So you got some good, you got some bad in there, things to watch for. But overall farm balance sheets, I think especially for crop producers, have improved primarily because of higher government payments, higher commodity prices, and strong land values. You drop any of those 3 out of the equation, then your balance sheet's going to change.
Roger McEowen is joining us, professor of agricultural law and taxation at the Washburn University School of Law. He will be holding the first of his 2 summer conferences coming up June 7th and 8th. It's going to be taking place in West Portsmouth, Ohio. So obviously some may not be able to attend. But Roger, first, I forgot to ask you about this. This conference is also going to be being streamed online as well?
Yeah, we will also broadcast it live online, and so people can register for that also. I would encourage, we have a differential rate, those that are claiming continuing ed for professional purposes and those that don't. And, of course, there's a lesser rate for farmers and so forth and others that are not claiming credit. So if you can't attend in person or come out to Montana in August, you can attend either of those conferences online.
Okay. Now, one more thing about on the economy side is everyone's going, so what are we looking at as far as the future is concerned? With the change in administration, we've still got the Farm Bill that's probably going to come up within the next couple of years as well. So how do you see that as far as how we prognosticate the future for the ag economy?
Yeah, this is where we pull the crystal ball out, set it on the desk, and give it a good rub. And it's never, this is never an accurate science here, but maybe there's some things from the past that can inform us for the future. And of course, we've got a different administration right now. We largely have recycled people that have been in these previous positions and have put them back in there. And so we can kind of get an indication of where we might be headed based on what they did in the past. And if we remember, under the previous Vilsack USDA administration, we may have taxpayer dollars that will still flow to the sector, but that doesn't mean it will still support traditional and ad hoc farm programs. It's more likely, I think, that taxpayer dollars will be used to support food stamps. Remember, we had a record number of people who were on food stamps the last time that Vilsack held the position. And you would see, I think we could predict that dollars would flow into programs defined as rural development and conservation programs. And, of course, with taxpayer dollars flowing to support conservation activities on farms and ranches comes regulation of private property. So we see concerns already with 30 by 30 type things. I think a lot of that is a little bit overblown right now. But given the past history of these people that are in charge, we have farmers that are concerned about those things, probably rightly so. As you mentioned, the next farm bill is probably going to come up, I would say around 2023. What will be the focus of the debate? I think much is going to depend on the outcome of the 2022 midterm elections. Will there be an examination of existing farm programs and how they apply to large farms compared to smaller ones? Will there be an even greater focus on the environment? Where are we at with WOTUS? There's already talk about rescinding the Trump WOTUS rule, which rescinded the Obama WOTUS rule. So around and around we go with respect to WOTUS. What about efforts to regulate carbon or illegal immigration issue? What's going to happen with respect to that? What's the policy going to be? What about ethanol production? Egg trade and exports is pretty, as I mentioned, is in a rather good spot right now. There was an emphasis on bilateral rather than multilateral trade agreements under the prior administration. Will that continue? Probably not. It's likely there'll be an emphasis on rejoining various multilateral trade agreements. So what will be the impact on ag? What about China? China now has more leverage on trade deals with the U.S., given the current administration, than it did with the previous administration. So what's going to be the impact of that? And then, of course, there's always the unknown, Greg, external factors and policies that bear on the bottom line of agricultural producers. What are those going to be? I don't know. That can come from the weather. It can come from various types of shocks. It can come from what Congress does. You got to remember in 2015, we had a $305 billion infrastructure bill, which seems to be totally forgotten now, because now we have a president that's at it again, wanting to spend taxpayer dollars on infrastructure. So we just had a massive one 6 years ago. What happened to that? Well, the monies for that didn't go to infrastructure. So they're going to do the same thing again. Well, I don't know. And then, of course, another unknown is tax policy, the potential for increased income and capital gain rates, the removal of stepped-up basis at debt, higher estate and gift tax rates coupled with lower exemptions, higher corporate tax rate. This is all significant as we align farm businesses for succession into the future. All of the economics and all of the tax gets rolled into this. And this is why I'm incorporating this discussion in these two major events that I'm doing this summer, these two-day conferences, because we've got a lot of moving parts here. And it's not just tax, it's not just estate tax, it's not just income tax, but it's also all this economic stuff that affects the bottom line of our farm producers out there. And we have to talk about all of these and be prepared to address them.
So in other words, everyone's crystal ball is a little murky right at the moment, potentially trying to see what's coming up here in the future.
That's right. That's a good way to put it.
All right. Roger, unfortunately, we're out of time. We had a couple of other great topics we were going to discuss, but obviously we can take that up in a couple of weeks and other things that may pop up. So, as always, appreciate it.
Thank you, Greg.
That is Roger McEowen, Professor of Agricultural Law and Taxation at the Washburn University School of Law, as he joins us on the Ag Issues program here on 580 WIBW.